Good morning, everybody. Afternoon, depending on where you are and when you hear this. Welcome to the weekly market analysis session. My name is Carl Capolingo. I'm the market analyst over here at Think Markets Australia. And it is a pleasure to be with you as we delve into all the key events from last week and have a look to the week ahead. I should say it is Monday, 24th of October. Let's kick off with a look at crypto markets. And as I say this every week, I need to take the snapshot sometime. Crypto trades 24/7. So I do a Saturday to Saturday weekly snapshot. Of course, we've had some trading since then, and crypto markets are up. We've seen about 2.5% increase in Bitcoin, a 3.5%, nearly 4% increase in Ethereum on top of what you can see there. But hey, it wasn't a terrible week at all last week. And by that, I mean, look at some of the horribleness that has come through there on the 1 month, I shouldn't say gains, declines, and 1 year declines. So to get some green on the screen, in addition to what's happened the last 24 hours, is fantastic. It hasn't changed the fear and greed index a whole lot. We're still at 23, which is extreme fear. And we're going to see in a second when we look at the charts that there hasn't been a whole lot. Let me go there. I should do that first. A whole lot to get people excited. Looking at the chart of Bitcoin now, there haven't been too many narratives, I think, to inspire people. Having said that, the technicals may do so because we're pressed into such a tight range between, say, 2450 and 18160. It doesn't take a whole lot now to break some of those key upside supply levels and get a little bit of FOMO back in. So above 2450, I'm going to start to get a little bit more interested. Above 22793, Bitcoin's going to be in the news. It's going to be, you're going to hear it frequently, and that could provide the spark that drags a few more people back in to potentially hunt the bottom there. Now, that's the best case scenario. Worst case scenario, it's still a possibility, is we go back down, we test and fail at 18,152, let's say, and then test and fail at the next level, which would be 17,585. But the silver lining, plenty of clouds there, but silver lining is that there's not far to go to get us back into some semblance of a short-term uptrend. You can see that also on the Ethereum chart. We're holding pretty well, I think, that range between, say, 1218 and 1356. We haven't seen a close beneath that. We've tested a couple of times. You can see that low there, 1181. But to the upside, again, not a long way to go to close above 1422. Get some interest back in this one. 1790 would be the next big level. Obviously, that dark pink zone here, and on Bitcoin, that long-term trend ribbon still, I think, holding prices down. But it'd be great to get a narrative. Quant had a little bit of narrative not that long ago. Obviously, these guys are very much into allowing financial services companies to conduct payments among themselves via the blockchain, but also whilst retaining a bunch of private information as well. They're also working on some CBDC projects as well. And they were presenting at a big payments conference not that long ago. That got them going. I started covering it, I think, in these sessions around about 140. I said 162 initially. Watch out for that level. It got there, pulled back, and then it boosted off that. And then I said 237. Got pretty close, 228. The high there has pulled back. I think if you've managed to get that run, I think we're lightening the load a little bit here, taking a little bit of profit on this one and keeping a little bit of skin in the game. The short-term trend is still very strong. Long-term trend is turning up. But I think given this blow off here, this upper shadow and this big black candle, and then another lower peak here, I don't think you want to be holding the whole position on Quant. Having a look at stock markets now, the standout here is US markets. Most of that came on Friday with that gain. NASDAQ up 5%, S&P up 5%, Dow Jones up nearly 5%. And ordinarily, when you say stock market's up 5% in a week, it is extraordinary. You very rarely would be able to say that, but we've been saying it quite frequently over the last few months, haven't we? But similarly, we're saying stock market's down 5% also. So it just speaks to the elevated volatility that stock investors are experiencing. You can see in terms of volatility, it actually came down last week. This is a weekly chart we're seeing on screen. It's come down there on that last candle. But if we look over the course of the year, we have been quite elevated compared to, say, if you go back to, say, 2016, 17, 18, where, a VIX between or around about 15 is probably the norm. The actual number, if we look at the median for 2022, is about 26.2 for the VIX. So you can see definitely elevated from your sort of long-term average around about 15. And in the pandemic there, we had, I think, about 28 off the top of my head. I did do these numbers. And then you'd have to go back to 2008, the GFC, to find another calendar year where volatility was so elevated. So obviously a global pandemic, let's make that an outlier. Really, the volatility we're seeing today hasn't been felt by markets since the global financial crisis. And that is official there in terms of the median VIX reading for a calendar year. European stocks got a little bit of the love from Friday and a little bit of a response about that. Asian markets are reacting today, and we just see the Australian market about 3 hours into trading now up about 2%. Looking at the S&P 500 technicals, earnings, we're very much in earnings season. They have pretty much come out better than expected. I think we've seen about just over two-thirds of companies have reported, and the vast majority of those, I think about 80% of them have reported better than expected. So most companies beating, but that's in terms of number. In terms of market capitalisation, about half the market cap is going to report this week. We've got the likes of Apple and Google, etc., coming up this week. So, if we see that continuing theme of better than expected earnings, then we could get another bit of a rally, I think, coming on. And in terms of the technicals, this big white candle, I mentioned it last week, just how important that is in signalling at a heightened probability of some sort of a bear market rally from here. I said, look, it's unlikely the bear market is over, but there's a high probability we get at least a rally into the light pink zone. And we did see that. This is Tuesday, Wednesday, Thursday, actually looking like supply coming back in that zone. And then we just saw that huge turnaround on Friday. So it's probably more like, yes, we've tested that, we've come back, and now we're holding higher with this extra white candle, probably going to push higher. Gut says somewhere around here is possibly the target, and that's a pretty decent rally from here, isn't it? But let's see how the candles play out at 38.07, 39.08 in the meantime. As I said, earnings will be a big part of that. A little bit of noise going on outside will persist. On the NASDAQ there, not as strong a rally. I think that's the message here, because this is a more risk-on market. So interesting to see the bigger blue chip stocks doing better than your more risky stocks in your technology sector. So that's interesting, but same sort of idea here, 11.231, 11.614. Let's see how the candles play out there, and we could be seeing as much as a rally into the dark pink zone. So it's not easy. It hasn't been easy if you're a bull, obviously. Markets have been trending lower. We can see that. But it hasn't been easy if you're a bear. And this is kind of the message I've been saying, is we're having, I think you still need to have very high cash levels and very small strategic bets on the best longs you can find, and then on the best shorts you can find as well. But you're not having a huge amount of capital at risk in the market because of that volatility. We say in choppy markets, traders get chopped up. Now, I think this is a really important picture we're seeing on screen. So this is the iron ore chart here, and we know stocks have rallied. We know they're probably going to continue to rally. Part of the reason for that is markets are starting to factor in a Fed slowdown in interest rate increases. That was most of the narrative from last week. That's still yet to be seen, but it's not about global growth just yet. So it's about, well, what is the Fed doing? And we're looking for any signs of relief from that to get a relief, nothing more than a relief rally in stocks. For stocks to have a sustainable rally, for this to be the bottom of the bear market, for this to be the start of the new bull market, we need to see this picture change. And this is the chart of iron ore. So this is the chart, really a chart dependent on global growth going forward. So until we see expectations for global growth improve, that is ultimately what is going to improve earnings for companies, consumer demand, et cetera, help governments pay off burgeoning balance sheets. Until we see those, I can't really put a lot of faith in the rally in stocks just yet. It's not happening in iron ore. The bulls will take heart from a small rally in copper and a little one there in nickel. The chart of tin looks horrendous, by the way. Now, just looking through some of those industrial commodities to give you an idea of this bigger macro theme. We've got coking coal. So coking coal obviously is used with iron ore to create steel. Steel is one of those key macro growth metrics. It is trending higher. Most of that is to do with supply shortages, though. We've had some unseasonably wet weather over in Australia has caused lower production at many of our coking coal producers. Looking at copper, Dr. Copper as we call it, such a ubiquitous metal used in so many industrial applications. If global growth is picking up, you will see this pick up. It did. Thursday, Friday, decent rally, but we're still in a long-term downtrend. Not getting too excited. If this starts to print 380, 390, hey, everything's back on again. If it starts to print 310 or have a two handle, the global economy is in the toilet, and you will see stocks respond drastically, I'd say, to the downside. Nickel, very subdued at this point in time. So we're not seeing these signs that from an industrial metal perspective, that global growth is turning around. Having a look at gold, this is not industrial metal at all, it's precious metals, so this is going to move more on the movement of the US dollar, really is probably the main thing, and just general risk on, risk off sentiment. We did see a little bit of a rally there on Friday, but overall the trend I think is still down, not getting too excited about that. Moving on to the energy, foreign exchange and bonds. In terms of energy, we did see weaker energy prices during the week, particularly natural gas, 22.6% fall. That is not a misprint, 22%, 1/5 of the value of the US natural gas contract wiped off. And that is going to do a couple of things. It's going to ease concerns over inflation, and it's going to ease concerns somewhat that we're going to have this big energy crunch in the Northern Hemisphere winter. European gas prices were also down, but not on screen. West Texas Intermediate crude oil held up better. We've still got some OPEC production cuts working their way through the system, balancing that out. Biden is talking, releasing a few more barrels from the Strategic Petroleum Reserve. In terms of the technicals for crude oil, and we'll look at natural gas in a second, look, it's very neutral at this stage. I did say last week, after this rally, we were going to go to a more neutral stance from a bearish stance. We've been bearish for a number of months, but I don't think we need to change that this week. Above 93.64, then I think you're swinging back to the bull case, and below 76.25, you're swinging back to the bear case. So I think out of that market in the meantime. Having a look at the currencies there, you can see the US dollar was weaker, and this is generally again showing that risk off. So the risk on sentiment coming, stocks going up. And the Aussie dollar getting the biggest benefit out of that, to be fair, probably a little bit of a rally there in some of those metals helping. And it has been outsized loser to the downside on the risk off theme. So getting a bit of a bounce. And we are seeing stock markets rally in the face of rising bond yields, which is unusual. You wouldn't normally expect that. That's natural gas. You can see the big wipe out there. We did talk about the possibility of that last week, actually, with this pattern. Is quite a bearish pattern, hitting the long-term trend zone, not bouncing, coming up, stopping at the short-term trend zone, and then coming back down from there. So not too surprising. Look, I don't think we're far off an area of demand between, say, 434 and 388. We'll see some stabilization from there, but we'll let the candles guide us. That's the European gas contract equivalent. Have a look at coal prices. I know lots of listeners interested in coal stocks. At the moment, your Whitehavens, New Hopes, Terracoms, etc., that are dependent on this price here, and it's holding up very well. Obviously, many of those energy contracts coming down, but again, it's the supply shortages. So we've had quarterly production reports from BHP and Whitehaven during the week saying that they're having production significantly negatively impacted by the wet weather conditions there. So that is helping coal prices avoid some of those natural gas declines. Interesting little one here throwing in this week is the rise in the uranium price, which is welcome for the uranium bulls, pushing back up to that 52.80 supply zone. Hey, if we can get above that, even print sort of 55 and higher, then I think there's probably some legs in this rally, but it's done pretty well, I think, to hold this pullback, show that this time, much like here, it's not going to be one of those sort of pre-pandemic wipeouts. I think there's starting to get some teeth on this rally, so that's good for the uranium bulls. Like a Boss Energy or a Paladin, so a BOE or a PDN on the ASX is a good place to start. Those companies are pretty close to production. A 92E would be my preferred pick in the Explorer space. Having a look at the US dollar index there, we can see it coming down. Again, if that does break down, so and it kind of looks like it, three lower peaks here, some pretty bearish candles, that would help risk on. So that would help stocks. And we're seeing the Aussie dollar respond in kind to this possibility that markets go a little bit more risk on. 65.50, I think, is the key level there. Obviously watching the pink zone, but I think this is the key level, watching for some supply coming back in around that zone. That's Australian government bonds. If it was a stock, you'd buy it with your ears pinned back. So that's not a good thing. We don't want to see interest rates go up because stocks, in theory, should struggle with higher rates of borrowing, higher input costs for borrowing, and then you've got higher costs to consumers. So via mortgage rates, we're going to consume less. So double whammy, negative for stocks, yet we are seeing stocks very strong in the face of that, and also similar gains there in the US 10s, but a bit of a reversal on Friday, and then 2. So I think markets probably still more optimistic than they should be, and this is another reason for that, the US 2s to 10s curve. And we're still seeing this orange line print higher and higher each week, and this is unbelievable. This is probably it's certainly the most unusual chart you're going to see today. Very few people understand what the hell's going on, though, but we're looking at the price of money over a period between 2 years and 10 years. Typically, you need to be compensated more for locking your money away in a bond over a longer period than a shorter period. It's not the case, and that is because the Fed is raising rates so aggressively, it's expected to do so, and with the expectation that that will hurt the economy down the track and cause interest rate decreases, you're getting lower rates out here. The last 9 times out of 9 times have predicted a recession. So we're waiting to see what happens this time around. And the fact that rates keep going up is not good either. Having a look at the impact of those rising rates on the US economy, a couple of data points from the week. Helping us do that, we can see the National Association of Home Builders Index. So this is home builders' confidence really falling off the proverbial cliff there. Falling down to 38, and that was less than the expectation of 43. So, analysts expecting to go down. It went down way further, and we're seeing some of those other housing metrics falling away as well. Okay, having a look at the Australian data here, we saw a 900 job increase there for the month, which was way less than expected. Analysts were expecting 25,000 increase, and it's well down from the previous month. Most of the positions created were full-time. However, if that's some silver lining, unemployment rate ticked up and the participation rate was steady. So we're seeing weaker Australian economic data. Obviously, the Reserve Bank has started to pull back a little bit, but the expectation is just that rather than get there all at once, they may continue to hike rates and just extend the length of this cycle. So same terminal rate, just longer to get there. Having a look at Aussie stocks, we're up about 2% in early trading here. So we're trading around that, in fact, just above that 6,800 level, 6,829. I would suggest to you as key resistance. Want to see how the candles print there. If you get a bunch of black candles come in around about 6,829, that would indicate there's plenty of supply still in the market and it's sell the rally. If we print a bunch of white candles in and around this zone, then we're going higher on this rally. The dark pink zone is a logical target, 70.15 and then 71.30 to the upside. I don't think we're going to get much further above that or even near there, to be fair. But let's see how we go in the pink zone. The sectors which did the worst during the week, healthcare, interesting. Staples and utilities, I point those 3 out because they're typically very defensive sectors. So seeing them perform so poorly last week is quite interesting. And materials coming off as well on lower global growth concerns. Doing the best, obviously, energy. The coal stock's still doing very, very well, but Woodside leading the charge there despite those lower natural gas prices. About 80% of Woodside's earnings come from natural gas, by the way. So interesting to see that one do so well. And financials were steady on the week, which, to be fair, in a down week was actually a win. And over the last few weeks, we've seen banking stocks, the big 4 banks, rise somewhere between around about 10 to 12%. Along with some reasonable performances in your big material stocks, is bench pressing this market, I believe. So a bunch of those, I'll just go back, a bunch of these index points through here, the 400 odd index points, I'm going to put to you, thumb in the air, about 300 of those points is coming from about 6 stocks, which means your market breadth isn't great. So your participation to the upside is still very, very limited. It's certainly not where we would need it to be to signal that we're in a new bull market trend. And therefore, I do think concern continues to be warranted. And this illustrates that very well. So we're looking at sector trends here, both in terms of short-term and long-term trends. Yes, energy doing well, still up and up there, mainly in the Woodside camp. Financials have got themselves, as I said, into a short-term uptrend, starting to turn their long-term trend. That'll be interesting. If that goes up, still more index points possible. But other than that, we're very much neutral or still heading down in our short-term trends, and the long-term trends are still almost exclusively down there. So it's hard to get too excited from a technical perspective. From a fundamental perspective, we can see that the current 1-year forward PE, so this is Thomson Reuters estimates here, they take a consensus measure from 15 to 20 different broking and research houses, and what their expectations are for earnings over the next 12 months divided by the price of the index. And we're at 12.8. Historically, 10 is signaled very cheap and 20 is signaled very expensive. So we're closer to cheap than expensive. We can see that since COVID, the top of the bull market, coincided with a reading of 20. That's no coincidence. If you look back at 87, 29, all the big bull market highs coincided with a reading above 20. That's pretty typical. And the bear market lows are about 10. Some of the interesting ones through here, I know people have asked in the past about, well, energy seems to be really cheap and materials seem to be really cheap as well, but these are cycling major earnings bumps that are expected to persist into next year, but they're not after that. So there is a bit of a value trap here with your energy and your materials plays, because as we get further than a year out, the earnings potentially in some cases are going to halve. So you can almost double these really to get the longer term value. So that's a bit of a trap. Other than that, the ones that are a bit more stable, healthcare getting pretty close to its pre-COVID average, but it is showing just how expensive healthcare still is. I know it's probably why it's the worst performing sector over the last few months. It's just still very expensive. Information technology peaked out nearly 80, and that is actually getting really close to its long-term average there. So I'm going to say, anything sort of sub 25, if you see that, it's going to say that tech is getting quite cheap. Apart from that, telecom's still very expensive. Staples getting pretty close to its long-term fair value range. Properties looking pretty cheap. And we've got financials there on the right side of cheap, I'd suggest. Discretionary getting pretty close to its long-term average after being beaten down. Looking ahead to this week, inflation data locally is going to be the big one. We've got a 1.6% quarter-on-quarter print there, a little bit lower than the previous 1.8%. And on the trimmed mean, which is what the Reserve Bank looks at, we're looking at a steady 1.5. So times that by 4, because it's quarterly, will give you about 6%. Doesn't it? So 6%, well above the Reserve Bank's sort of 2 to 3% average that they're looking for. Having a look overseas, we've got a huge data dump next week. US services and manufacturing data early in the week. The big China data dump there probably around about Wednesday. Consumer confidence survey. Advanced GDP. So we're looking for the US economy to bounce back, isn't it, in the September quarter? Big bounce back from the previous minus 0.6%. And then we're looking for durable goods orders and the Fed's preferred measure of inflation, the called PCE price index, coming out during the week with a monthly reading of 0.5%. So obviously times that by 12, you get about 6% again, don't you? And then personal income and personal spending data at the end. Well, that's it for me today. If you want some more analysis, tune in to Ask the Experts. If you're listening on YouTube, that's how you get there. www.thinkmarkets.com/au/learn-to-trade/webinars. It's a bit of a mouthful, but find that on the website. Click register, and we'll look forward to seeing you tomorrow. If you're not aware of who Think Markets is, we are the good guys in the Australian broking scene. Over 3,100 shares and ETFs to trade at an $8 flat rate, and it is HIN and Chess sponsored. Very important, that last point, because there are cheaper rates out there, but you will find that all of your holdings are going to be aggregated with a bunch of other people. So it's important that you have Chess sponsorship. You are the unambiguous beneficial owner of those shares. If you'd like to trade other products, CFDs, we've talked a lot about indices potentially having a little bit of a bounce there. We've talked about natural gas potentially getting close to a potential buy zone, and a few other things, interest rates, all sorts of things, crypto. You can trade them with us as well. So you can have your self-managed super fund account going over here on one side and have your CFD account going on the other side as well, all from the same client portal. Market leading spreads, commission free on shares, on share CFDs, I should say. So share CFDs, you pay no commission. Very important. If you're a small trader just getting started, you don't want commissions eating away at those profits. www.thinkmarkets.com.au for details. Award-winning broker, multi-asset platform, as I mentioned, world-class trading apps, dedicated account manager with 24/7 customer support. If you're watching me on YouTube, make sure you hit the subscribe button to stay notified of any future updates. We'll stream regularly during the week, and we've got a bunch of material there on the website for you to use, a bunch of great content. Hit the thumbs up button, very important, to let me know you like what I'm doing, so I will continue to do more of it. Apart from that, it's been a pleasure chatting with you today. All the best if you're trading and investing. Till we catch up again. Bye-bye for now.